Healthcare stocks have been crushed. Right now, healthcare is just one of 3 sectors in the S&P 500 with negative performance this year, underperforming the broader market by 13%. But within the noise, there are opportunities for long-term investors, and one of the most attractive ones I found is Edwards Lifesciences. Despite riding powerful trends like aging global population, Edwards stock is down nearly 40% from its all-time highs, and in my view, it's trading at a 32% discount to its fair value. As always, I built a 10-year forecast for revenue and free cash flow, and my fair share price lands at $114 per share, implying an 18% expected annual return. I'm also giving the stock a buy rating and 4.5 out of 5 stars. In this video, I'll start off by explaining what Edwards actually does so well, then analyze its financials, followed by a detailed bull and bear case valuation. So yeah, let's dive in. Now, before discussing Edwards' business model, let's take a look at a quick snapshot of how the company has performed over the past year. We can see that revenue has grown by close to 9% and EBITDA has grown by over 12%. At the same time, the company has carved out a healthy EBITDA margin of 32% and the share price has actually risen close to 28% over the past year. Now, the company is of course American, it's headquartered in California in the United States. So Edwards isn't your typical medical device stock. This is a company laser focused on structural heart disease, and it dominates the transcatheter heart valve market globally. And in this video, I'll refer to it as TAVR. TAVR is used when the aortic valve narrows and restricts blood flow from the heart to the rest of the body. And this procedure replaces the damaged valve with an artificial one. And Edwards TAVR stands out as a non-invasive valve that offers patients faster recovery, less pain, and a life-changing alternative to open heart surgery. Today, TAVR represents over 70% of Edwards' revenue. Its innovations have literally saved lives, and with an aging population worldwide, the total addressable market is growing fast. Over the past 10 years, Edwards has nearly tripled its revenue, quadrupled its free cash flow, and has done all of that with no long-term debt on its balance sheet. And yet, the stock has been under pressure, margins have compressed, and growth has slowed from its pandemic-era highs. But I believe the current dip is an opportunity if you're a long-term investor. And with that said, I think the bull case is quite clear. First of all, we have an aging population. Over 10 million people suffer from aortic stenosis, and demand for TAVR will rise with global aging. In 50 years, the proportion of global population aged 60 and over will increase from about 1 in 11 today to 1 in 6. And then we have Edwards as a market leader. Edwards dominates the US market with its first mover advantage, strong clinical data, and a growing pipeline. And then lastly, we have financial strength. Gross margins are above 75%, we have no long-term debt, and consistent R&D reinvestment that makes the company highly resilient. But of course, we have a few risks. First of all, we have hospital constraints. Budget cuts and staffing shortages may delay procedures and slow TAVR growth. And lastly, we have new treatment risk. Early stage heart therapies face challenges with trials, hospital adoption, and insurance approval. Okay, so now we have a sense of what makes Edwards' business model so unique. Let's move on and look at some historical financial data that we'll later on use in our valuation. And I'll start off by showing you the core financial performance over the past 5 years. Here we can see revenue in blue and we can see EBITDA in green. And revenue has grown by 6% on average in the past few years and EBITDA by 13%, so profitability has expanded. Now, the reason why the stock hasn't performed so well in the past few years has to do with a spike in 2021 when the stock made its all-time highs. At that time, right after the pandemic, investors were overly excited with growth and the multiple and valuation just expanded too quickly, and then the dip came in 2022 when the stock took a hit. But since then, growth has resumed, right? We can see that growth is consistent for revenue and EBITDA is close to its all-time high in 2021. Now, another fantastic chart that shows the strength and resilience of the company has to do with the debt sustainability. And this really shows the strength of the balance sheet of Edwards. So here we can see the debt in purple, right? And we can see the excess cash. And if you compare the size of the excess cash versus the debt, there's no risk at all for us as investors. The company has plenty of cash to reinvest into R&D for new products, new trials, in the future. Now, as we later on will take a look at the free cash flow as part of our valuation, let's also take a look at the free cash flow performance of Edwards in the past 5 years. Here we can see revenue again, and instead of EBITDA, we have the free cash flow to equity, so that's the relevant free cash flow for us as investors. Now, what stands out here is the dip in free cash flow in 2024, and this has to do with the sale of its critical care business in 2023. The company had to pay a substantial amount of tax due to that sale, and this also explains why the excess cash in the company is so high right now, as you saw in the previous chart. And the final chart I would like to show you has to do with the share performance of the company. Now here we can see the shares in two dimensions. First of all, we have the number of shares outstanding in the company, that's the blue bars. We can see that has been reduced by 1% per year, showing that the company is actively buying back stock. That's a great sign for investors. At the same time, we can see the average yearly share price of the stock, right? We can see it peaked in 2021, and since then it's been quite flat, right, as the valuation has come down, making the stock much more attractive for new investors. Okay, let's jump to the interesting part, which of course is the stock valuation, and see why I believe this stock could be undervalued today. And as always, let's start off with my assumptions to see how I believe the company could perform in the coming 10 years, all the way up to 2034, including 2025. And starting off with revenue growth, I'm assuming 11% per year. Now this is much lower than the growth the company had prior to the pandemic. Then it could easily do 18-20% per year, but it's higher than it has performed in the past 5 years. So a slight re-acceleration in growth, also with global trends with aging, etc, etc. In terms of EBITDA margin, I'm assuming 35%. That's slightly higher than in the past 5 years. I think that's a conservative assumption. And in terms of the enterprise value to EBITDA multiple, I'm assuming 25 times. In the past 5 years, it's been 36 times on average. So moving on to my free cash flow assumptions, I'm assuming 12% growth for free cash flow. That's higher than the revenue growth, assuming that the company can keep expanding its profitability as it has done over the past few years, right? Now, in terms of the free cash flow yield, I'm assuming 2%. The free cash flow yield is how much free cash flow we get relative to the share price. So I'm assuming more free cash flow than the 1.6% we've seen in the past 5 years. And finally, for the discount rate, I'm using 9.4%. I think that's realistic for a company like Edwards Lifesciences. And with all of those assumptions in mind, here you can see a summary of the revenue and the free cash flow that I'm forecasting for Edwards all the way up to 2034. Now, the important takeaway here is to look closely at my growth rates. For 2025, for instance, I'm assuming 12% revenue growth. That's in line with the company's guidance. And then I'm re-accelerating growth all the way up to 16% in 2027. Now, this re-acceleration is more in line with the company's previous growth rates and global trends, for instance, with global aging, as I mentioned before. Now, there is an exciting opportunity where this growth actually keeps accelerating all the way up to 2034. That could happen, but in order to stay conservative, I've of course decelerated growth all the way down to 7%. And using those forecasts, we can actually extrapolate two price targets, an enterprise value price target and a free cash flow price target in 2034. Now, if we weigh them equally, we get a weighted price target of roughly $278 per share. Now, this is excluding all the free cash flow that we'll get during that time in terms of share buybacks or dividends or however it might be in the coming 10 years. And to recap, all of these assumptions then shows that the fair share price, if we discount all the future cash flows to a present value of today, that it lands at roughly $114 per share. This is a discount of 32% versus its current share price and an annual expected return that we as investors could get at 18%, which comfortably beats the market at roughly 9 to 10%. And this chart basically shows you how this investment could pan out for us as investors if everything goes according to plan. So in 2025, which of course is now, we have to buy the stock, right? That's negative cash flow for us as investors. But if we hold the stock, we will get, of course, free cash flow distributed to us as buybacks or as dividends or however it might be. The shares could, of course, appreciate in that time, all the way up to 2034, when we sell the stock at our weighted price target, and then we can see our total gains, which are quite substantial versus the initial stock investment that we have to do today. Now, every investment, of course, comes with risk. No matter how amazing a company can be, like Edwards, there is always risk investing and buying stock. So I like to do a bear case valuation as well and see how big is the downside if my assumptions are just too optimistic. So in this bear case, I'm assuming revenue growth and free cash flow growth at just 5% per year, which is substantially lower than the company has performed historically. Now, if we have those growth rates, we get actually a fair share price of $67 per share. And this suggests then that the stock is actually overvalued by 18%. This also implies a new annual return at just 7% per year, which isn't negative, but 7% isn't great when holding an individual stock like this. So it all depends where you think this company will go in terms of growth. Now, of course, I started a small position in Edwards Lifesciences, and the reason why I started only a small one has to do with the seasonality of the overall market. This basically means that some months are much stronger on average than others. And you can see where we are today. We're in August of 2025, and August and September are by far the weakest months in the market each year on average. So my strategy and my plan here is that I've started a very small position, and then hopefully in August and September in case the market corrects a few percentage points, then I'll be able to increase my position in Edwards at a much better price. And this is a good tip for me as an investor to you, right? That when buying new stocks, right, keep in mind seasonality. Usually I like to buy a lot of new stocks, right, in mid-October, because then November comes, right? And that's the strongest month on average each year for the stock market. Now let's also do a quick and simple technical analysis of Edwards stock chart. We can see that stock price since the pandemic went up quite aggressively, but since 2022 it has course corrected down to its kind of normal long-term upward sloping trend line. I think this is also a good buying opportunity for investors. The stock price is close to its trend line and it's above its 200-day moving average, which is another bullish indicator. And if we zoom in a bit, we can see the stock price where it is today, right? And the stock price has basically risen over the past year since its horrific earnings report last July of last year, where the stock went down by I think 30%. Now as September is around the corner, stock actually could go down again, right? But I think a more realistic price would be, I guess, in the mid 70s or in the high 60s. Now if you're also looking at the stock as a potential investment, here you can see what happens to the annual expected return. If the stock price goes up, that's bad for new investors, or if the stock price goes down. Now currently we're at 18% per year. That's good enough for me as an investor. I like between 15 and 20%. But if the stock would go down by, I know, 10 or 15%, then the expected annual return becomes 20, 21 or even 22% if the stock price goes down to the low 60s. So it all depends what happens in the next few weeks and months, right? And let's conclude this video by looking at my final rating. As I mentioned in the introduction, I gave the company a buy recommendation and 4.5 out of 5 stars. And here you can see all my key considerations behind that final rating. Where the company has scored really well has of course to do with its low debt and its strong free cash flow and EBITDA growth. On top of that, we have an attractive valuation and the moat strength is 555 across the board. This is an amazing company. Now where the company hasn't scored that well, of course, has to do with the revenue growth over the past 5 years. 6% isn't that impressive and the stock performance hasn't been that consistent as well. But hopefully with this lower valuation and with global trends like aging, as I mentioned several times, this is a great buying opportunity into one of the best healthcare stocks in the world. Thank you so much for watching this video. If you found it informative, please feel free to like and subscribe. And if you go down to the link in the description below, you get a free one-pager which includes 5 years of financial data, my full DCF assumptions, and the forecast summary as well. So yeah, thank you and I'll see you in the next one.